welcome everyone to the fundamentals of funding your startup. My name is Louis Wharton. I'm a partner with Stubbs Alderton Marklees, and on behalf of myself and my co-presenter, Obi Onyejekwe, I'd like to welcome you to the session. Before we get started, I wanted to let you know that today's session is going to be conversational. So Obi and I will have a conversation whereby I introduce a topic and provide somewhat of the legal framework with respect to the topic. And then Obi will provide his perspective as an entrepreneur and someone who's been through the process. So we think that the combination of the legal and technical framework combined with the practical realities of how these things work should provide hopefully what will be a fairly informative session. Briefly about myself, I'm a partner, as I said, with Stubbs Alderton Marklees. I've been practicing law for about 20 years. My practice focuses on mergers and acquisitions, public securities work, but primarily on assisting funding sources, entrepreneurs, and companies in structuring, negotiating, and documenting financing transactions. So I've got lots of experience working with companies and funding sources as they negotiate and structure anything from a safe financing to a Series A, Series B convertible note, etc. So I'll be giving you my perspective with respect to the legal framework regarding these topics. And now I'm going to hand it over to Obi.
Hi, my name is Obi Onyejekwe, and I'm the CEO and founder of Unami. So Unami is a software as a service for animators and video game developers. So we developed some of the most advanced AI technology that automates the most complex tasks for animators and video game developers. So we do that with our 2D and 3D lip syncing tool. We also have an avatar creator tool that's in development now. And we also have our motion capture software that tracks human movement without special cameras or tracking suits. You could just simply record a human, upload the footage to Unami, and it'll track that movement. We also have a voiceover technology that ultimately tracks errors in audiobooks as well. So we're currently raising capital on our equity crowd fund on microventures, and we'll talk more about that throughout this discussion and take it from there.
Great. A few additional points. As part of my background, I was the president of the Precelerator, which is an early stage incubator and accelerator that we host at Stubbs Alderton. And Obi and Unami were actually one of the companies that we incubated in our Precelerator. And Obi has had a continuing relationship with the firm since that time. And so he'll be providing, again, his perspective as one of our Precelerator companies in connection with what he's gone through from a funding perspective. We'd also like to make this session somewhat interactive. And so to the extent that you've got questions as we go through the session, feel free to put those in the chat. We will save some time at the end for an official Q&A. But if you've got a question with respect to something that we've discussed or some information that you'd like to receive, then feel free to, again, put that in the chat. And to the extent that we can get to it, we will. Okay, and so without further ado, let's get started. So as an overview of what we'll be discussing today, we're going to go through the various types of investors and investment that you are likely to obtain in the course of soliciting fundraising for your company. So those items will include bootstrapping your company, prizes, grants, and awards, which several of you are probably familiar with, friends and family rounds and what that entails, obtaining money from angels, venture capitalists, corporate venture capitalists, or strategic investors, as well as obtaining money from the crowd or crowdfunding. Preliminarily, excuse me, we'd like to discuss a few of the items that you should discuss or think about when you're looking to fundraise. So the first thing that we think is important is to have a funding strategy. So you should be planning on soliciting multiple investors from multiple sources, making sure that you understand the requirements and focus of the applicable funding source, right? How are you going to use your proceeds? You should have in mind how much you need to raise, what you'll use the money to accomplish, a product roadmap, and over what period of time you think you're going to be using that money. So 12 to 18 months is typical. And then the third is, what material should you have on hand to essentially make available to investors versus materials that you yourself consult. And so most investors will want to receive an executive summary, which is a very brief document outlining the company, the problem it's trying to solve, its product, and a few key metrics, right? That's something that's brief, but communicates all of the salient points in connection with your company and what it's doing. Separately, if you get to the point where you actually are invited for a meeting or a pitch, you should have a pitch deck. which builds on the executive summary. Usually that's about 10 to 15 slides and goes into more detail with respect to the information that you've included in your executive summary. And then finally, what you would have as the background is, a business plan, essentially. So that's a much more detailed, robust document, rarely shared with investors, something you and your team consult. And that's somewhat of the roadmap and guidance in connection with how you're going to build this business. So usually include assumptions regarding financial projections, assumptions regarding personnel, who you need to hire and when, assumptions regarding how you're going to spend capital, et cetera, right? So that's a much more robust document. Again, usually you consult that internally, you rarely share that with investors. And then finally, the other thing that you should be prepared to provide is a diligence packet. So to the extent that you enter into a conversation with investing sources, they'll usually want to see documentation regarding your corporate records, right? The formation of your business, how it's organized, how you and your co-founders have allocated equity, how have you documented the allocation of that equity, whether or not you have material agreements with customers, whether or not you have material agreements with vendors and sources that are assisting in building your company and its product, how you've addressed intellectual property and the protection of the intellectual property, and several other items that may be requested by the funding sources. So again, generally speaking, a funding strategy, understanding use of proceeds, having documentation such as an executive summary or a pitch deck, and then finally having your diligence materials organized. So Obi, my question for you here is essentially, when you were thinking about first going out to obtain capital, how did you think about and address the various topics with respect to having your house in order, right, in order to provide materials that investors would expect? So can you talk a bit about your funding strategy and how you thought about use of proceeds, as well as the diligence materials and executive summary that you provided to potential investors?
Yeah, so once I got past the phase of starting the company, forming Delaware C Corp, and a couple other legal documents, then yeah, I instantly went straight to the pitch deck and of course executive summary. For me personally, I roll them out both together, just because some investors will ask for both. Some will just want the pitch deck, and some will actually ask for both the pitch deck and executive summary after that. And then recently, I've started doing like a one pager. I think there's a whole new breed that kind of wants a one pager to kind of go along with everything, or that's what they want to start with. So kind of do that too. But the pitch deck is ultimately what I send out the most.
And can you let us know what do you include in that one pager, right? So just, again, don't have to be specific, but just some guidelines with respect to, what investors have been requesting. What do they often want to see right at the front at the beginning?
Yeah, so overall what the company does and how it makes money and in the market. So, brief paragraph that breaks down what the company is, what the product is, the pain point it solves in the market, how big the market is. That's huge for investors. They want to know how big this addressable market is and how much money they could potentially make in that market. And then ultimately how you're solving it. That's pretty much all you're going to be able to squeeze. And then your team. That's how the most important thing is, getting your team in there. They really want to see that this is an experienced group of individuals that can actually carry out the task and achieve this goal.
Okay. And then how did you think about your funding strategy? So before you actually went out to folks, what were your, what process did you undertake to figure out kind of who you were going to go to, when, in what time frame, et cetera? How did you think about actually starting the process of going out to actually raise capital?
Yeah, so for me, I skipped kind of like that early stage friends and family because I didn't really have people in my camp that could really come to the table and finance this. So it meant, for my first startup, it meant overtime, doing side freelance gigs to pay for that venture. And then once I built a minimal viable product that worked and that was very impressive, then I reached out to angel investors at that point. That's generally the market that you're going to go to first. You could flirt with some VCs. I think the benefit of talking to VCs early is getting a sense of their mindset. Some might be blown away and come in, but even if they say no, it's a learning experience, and you'll be able to see, okay, they said no, but it's X, Y, Z, and these are the things I need to correct and get on point before I approach them again in the future.
Yeah. So I think you're raising some really important questions with respect to thinking about who the right investors for your business are, right, depending on the stage of the investment, and what are some of the differences that you can expect with respect to going out to different investors. So let's touch on those topics briefly.
Yeah.
So, And I'll provide some feedback, and then you should feel free to jump in.
Cool.
So typically, when you're going out to seek funding, you should be thinking about what stage of business is your company at, right? How much have you developed? Are you simply at the idea stage? Do you have wireframes, setting out what your app or product are going to look like? Do you have an MVP or a minimum viable product, right? Do you have users and customers that are providing information? Or are you generating revenue, right? All of those factors are what you should be considering in connection with thinking about the right type of investor to go to, right? Investors, sometimes will invest in the seed stage. Some will invest pre-revenue. Some won't invest until you've got revenue, right? Some need to see at least an MVP. Others need to see an actual product. Some need to see user metrics and growth metrics. Others need to see, additional metrics. And so having all of that in mind is important in connection with figuring out who the right investing source will be, right? So that's issue number one. So what stage of development is your company at? And then the other stage and corollary to that is something that I just mentioned, which is essentially where are investors investing, right? At what stage in what industry? So understanding that investors want to invest in pre-seed companies, focusing on artificial intelligence is important, right? You certainly don't want to go to an investor that isn't investing in your segment or isn't investing at your stage of development. So it's critical that when thinking about the investor that you're going to go to, that you figure out and do your diligence, right? Do some research with respect to whether or not the investor is actually interested in investing at your stage. Now, there's a caveat to that I'll mention, which is it's probably appropriate if you know that an investor is going to be potentially interested in investing later on. There's nothing wrong with establishing a relationship with the investor, right, before they're ready or before your company is in the sweet spot for them to invest, right? What's helpful about that is the investor gets to know your company early, gets to know you and your team early, you establish a relationship. You can keep the investor informed with respect to information and developments that occur at the company so that when you're ready to actually go seek investment, they've got a ton of information and they understand the history and growth of the business so that you are in a better position to discuss the key metrics and the key movers, right? That should make them more interested in actually investing in the company. So establishing relationships early on with the right types of investors, going out to investors when it's time for them to actually invest in your company, understanding how those factors all interplay, those are all important, right? And so the recommendation here is to do your research so you understand when you're ready with respect to which investors. So Obi, would love to get your feedback on your thoughts on that as well.
Yeah, I agree. I mean, I think what was most important when I rolled out, especially with my level of technology or this level of technology in our company, is we really needed investors that understood the technology the most or the industry the most. So that's another component. Is a lot of times investors will say agnostic and they kind of invest in everything, but what's important is that they really understand the industry quite a bit, because even though they say agnostic, the minute they feel like they don't understand or if they don't have enough experience in the industry overall, they generally won't invest unless the revenue is there. So that was a huge component for me personally when reaching out to investors. Let's say, determining early stage versus later. If you're early, I would say state it up front, just really be transparent about the metrics that you're doing, or if you're pre-product, or if it's just MVP, because that really gets to the nuts and bolts of what they're looking for and what they're not. And like you said, if they're not ready, then you could just establish that relationship, save their info, and then follow back once you hit the metric that they're looking for. And once again, if you don't have it, it's good to at least say, okay, look, you prefer coming in. Well, I think when we're generating revenue, what kind of numbers does that look like? You prefer coming in maybe when when the product's ready. Can you give us details on past investments that you've come in at that level, to make sure that when we are at that level, we're not wasting their time when we reach back out to them.
Great. And then really briefly, when you went out, where were you? Were you MVP? Were you, post MVP, working towards a more commercial product? Where were you when you actually went out?
I was definitely in between MVP and getting to the commercial product. We had a working prototype. There were a lot of things that weren't implemented yet, like a full-on checkout process needed a bit of work. and a couple other features that needed to be added to the actual software. So I felt like since we were good enough, we had something impressive to at least show people. Like, well, look, we actually built this thing. I felt like that was a good point to start going out and get the feelers out. You may go through that process and realize people are still not ready to invest, especially even the early stage investors. They might want, you know what, we much rather you come back when it's fully built out and you at least have a few customers. So you still might get that feedback after you make that call.
Okay. And then maybe final point on the overview regarding investors. I think it's important to understand, some of the differences among investors, and these are kind of high level, right? So sophistication may vary both in terms of the, information with respect to your segmented industry, right? Having experience and expertise in the industry versus not, as you mentioned, whether or not the investor is accredited, something we'll talk about later, right? And so briefly, for the definition of an accredited investor is an individual that has made $200,000 over the last 2 years or $300,000 with their spouse over the last 2 years with a reasonable expectation that they're going to make that amount this year, or they have a net worth of at least $1 million excluding the value of their primary residence. Those are the two most used criteria in determining whether or not someone is an accredited investor. There are other criteria as well, but those are the two main points. So understanding whether or not the investor is accredited versus unaccredited impacts the exemptions under applicable securities laws that the company can rely on in actually issuing stock. And we'll get into that more in a bit. Will the investor be active or passive, right? Some investors are happy to write you a check and then kind of sit back and let it ride. Others want to be much more active and involved in connection with your business, consulting, having information with respect to developments, et cetera. And so understanding the type of investor that you're getting and your tolerance for an active versus passive investor, I think is also very important. In addition, you should be considering whether or not the investor brings a broader network and can provide additional externalities positive, right? So in addition to just writing you a check, which is obviously important, can the investor make introductions to folks in your industry, right? Can the investor connect you to their network to the extent that you need to find, for example, a chief technical officer, or perhaps a sales agent, right? So thinking about the other benefits that can be provided from an investor, I think are also important. So it's not just about the money, it's also about all the other benefits that an investor can bring to bear when providing investment into your company. So any thoughts on that, Obi, before we move into the specific segments regarding capital?
Yeah, I mean, I think those are great points. I think for me, all my investors pretty much have been passive, but it was always important that a lot of them did come to the table with additional resources, whether it be intros to networks or various agencies to help scale the company or even potentially lock in sales. I think one thing to do as well is if they are really selling you on coming to the table with these resources, to interview them back and find out the details of that, because there's a big difference between, hey, I can connect you with like NVIDIA and lock in a potential multi-million-dollar deal versus, oh, I think I know somebody at Disney or something like that. So those are two very significant resources, and it's good to know the extreme details because that could be a very game-changing piece of information.
Agreed. Okay, so let's move into it. So we're going to start talking about the various tiers. So briefly, we're going to first address, bootstrapping, grants, awards, and prizes, along with friends and family money. So typically, this is the earliest money that you as an entrepreneur will obtain, right? And so bootstrapping essentially refers to you using your own capital, as much of it as you've got and can scrounge, together, in order to actually fund the growth and development of your business, right? So tapping into your savings, tapping out your savings, essentially, borrowing against credit cards, running up credit card debt, taking out, personal loans. This is money that you yourself generally put into the business. And that's usually how most of these ventures get started, right? You've got to actually believe in yourself and create something in order to actually demonstrate to others. Similarly, at very early stages, it's possible to get grants, prizes, or awards that are typically non-dilutive. And by that, I mean essentially you obtain the cash without actually having to give out equity, so your ownership in the company remains the same, right? And so there are competitions, contests, grant processes that you may be able to apply to in order to get non-dilutive capital. So to the extent that you're thinking about, starting a business, or you're at the very earliest stages of starting a business, that's likely the capital that you're going to obtain. And then, as Obi referenced, there are also what's referred to as the friends and family round, right? So that's the circumstance in which you go out to the folks you know, right? The people who know you, believe in your vision, in order to actually raise capital for the business, right? They are literally providing investment on a hope and a prayer because they believe in you. And typically the security that you provide for friends and family investment is common stock. That's the same stock that you as the founder typically will obtain at the formation of the business, right? And so the other point to note about friends and family rounds are essentially typically the investors in a friends and family round are unaccredited, right? Unless you've got some high network folks in your network, which is fantastic, in which case you can obtain investment from accredited investors. But usually the friends and family round will be raised from unaccredited investors. And so it's important to be mindful about the circumstances under which you can issue securities in that round, right? The company needs to ensure that it is compliant with applicable securities laws when it issues securities in connection with investment. And there are exemptions under both federal and state law that permit companies to obtain investment from unaccredited investors. But there are lots of requirements that need to be followed in connection with obtaining that investment. So to the extent that you're looking to do a friends and family round, I think it's important that you reach out to folks in your network or counsel who can appropriately advise in connection with how you actually go about raising that capital, the instrument that you provide, and how you comply with applicable laws in connection with the financing round. So I guess, Obi, I know that you mentioned that you kind of skipped the friends and family round, but did you ever, go through the grant or, prize process to obtain capital? Can you talk about that briefly?
No, like I definitely did a search. There wasn't much out there, and to be honest, looking back, I probably should have looked a little bit more. There was one recently I saw a few months back. It was definitely a government grant for like very advanced technology, similar to like what we're working on, what we're doing. The only reason why I didn't move forward is it was a very long, arduous process. So I had to really decide, okay, are you going to really focus on building, scaling, locking in sales, or are you going to focus on this? And it was really going to take away a significant amount of time. But I definitely did the whole after bootstrapping. I definitely did the whole, reaching out to, I eventually locked in a deal with Backstage Capital, so they invested. But before that, of course, I went through the pre-accelerator that helped tremendously with Stubs. And of course, there's the option of going to multiple other accelerators, whether it be Techstar or Y Combinator. So that's a nice bridge, but yeah, you're still going to definitely need a significant amount of capital to even get to that point of going down that route.
Yeah, I think those are good points, which is essentially to the extent that you can apply to and be accepted in an accelerator, right? That they usually provide capital in connection with, depending on the accelerator, obviously, but they provide capital as part of the intake for being a cohort member. And the terms of the capital that they provide obviously vary, but to the extent that you have the ability to, be accepted into one of those accelerators, there could be a significant advantage, both in terms of mentorship, in terms of access to capital, in terms of actual business advice, right? In addition to actual dollars, right? So I think it's an important point to make. And again, usually you would go through that accelerator process or that incubator process prior to the angel round, which we'll talk about next, but probably after the friends and family round, because usually they require, some product, some MVP in order to actually be accepted.
Mm-hmm.
Okay. All right. So then once you've gotten past the friends and family round, typically what you do is, in this outside capital raising process, is you seek money from angel investors. And angel investors are essentially just high net worth individuals, folks who've made a ton of cash, and they're looking to invest cash in early stage businesses that are highly risky, but to the extent that they're successful, provide significant reward, right? And so you may have heard of two of the most significant angel groups in Los Angeles. That would be Tech Coast Angels and Pasadena Angels. Both are very active in the community. Both have websites where you can apply for consideration by the angel group. But again, that's money that's usually raised in connection with at least having an MVP or a product. And typically the angel investment takes three forms. So either a safe instrument, a convertible note, or priced equity. We'll briefly talk about those. So you probably heard of safes, which are simple agreements for future equity. And the safe is essentially just a contract whereby an investor says, I'm going to invest money in your company, and you agree to provide equity if and when the company consummates a financing that meets certain terms. So for example, you might require the automatic conversion of the safe in connection with raising $1 million of preferred stock, right? Safes usually convert either at a discount to the price at which you issue securities. So let's say if you're issuing shares at $1 and the safe has a 15% discount, then you issue shares upon conversion of the safe at 85 cents as opposed to $1. The alternative is to have a valuation cap, which essentially says when these safes convert, we take this value for the business, and that's the value we use to determine the price per share. Generally speaking, safes have somewhat of the ability to defer the conversation with respect to valuation, particularly for early businesses, because it's uncertain what your business is actually worth at the very early stages, right? You as the founder and entrepreneur want your business to be worth more. The angel investor thinks your business is probably worth less because it's very early stage and risky. And so how do you really have a meeting of the minds in connection with where the valuation should fall and what's correct? Well, one of the ways in which we can kind of defer that conversation is by having this convertible instrument, right? And so notwithstanding the fact that there is a valuation cap, which is some indication of where the valuation probably is, at the end of the day, the safes will actually be converting into common equity based on the terms that are negotiated for a subsequent round. So the things to remember about a safe is just a contract pursuant to which an investor provides investment to your company. Usually it has a discount. Usually it has a valuation cap, right? It doesn't have a maturity date. It doesn't bear interest. And in connection with a wind down of your business, then it's required to be repaid in the priority of preferred stock. Okay, so those are kind of the general points of it. With respect to convertible notes, they have similar rights to a safe. Convertible notes are debt, right? And so you have to record them as debt on your books and records. They typically have a maturity date anywhere up to 3 years. They typically bear interest. I would say these days you can probably get a fairly low interest rate, but I've seen as high as 8%. And again, they also convert automatically in connection with the company raising a particular type of financing round. So again, preferred stock, at a minimum raise of $1 million or more, right? And they also typically have either a conversion discount or a conversion cap. The other thing to note about a convertible note is that essentially the note typically has a premium in connection with the company undergoing a change of control. So at the option of the investor, either the investor will receive anywhere from 1.5 to 2x their investment to essentially provide a return on the capital that they've invested, or they get to convert into equity and participate in the change of control transaction. And they'll determine whether or not the return of the premium or conversion is going to result in a larger distribution for them. Okay, so remember, convertible notes, maturity date, interest, debt, right? Typically change of control premium, also automatically convert in connection with a qualified financing, usually involving preferred stock, raised at a set threshold. And then finally, the angels may insist on obtaining preferred stock, actual equity in the company, at which point you'd actually have to agree on a valuation. Typically, that would be Series Seed, SEED, preferred stock, right? And Series Seed preferred stock is a little less robust than Series A, which we'll get into in a minute. But usually it has a 1x liquidation preference, which essentially means that the investors get their money back first before any proceeds are distributed to the holders of common stock. Dividends are usually if and when declared by the company. Typically, early stage businesses don't declare dividends, so the dividends are never paid. They may have certain veto rights, also known as protective provisions, in connection with material changes at the company. So, for example, amending the corporate documents, entering into a merger, increasing the size of the board. And then finally, Major investors, defined as investors, investing at least some of, threshold 100, 200,000 maybe, will receive certain information rights. So information with respect to the financial performance of the business, as well as participation rights, the ability to invest in pro rata subsequent issuances of stock by the company. Okay. So that's kind of the general basket in connection with Series C preferred. So remember, typically when you're going out for angel investment, you've got high net worth individuals, fairly sophisticated, either in connection with investing in early stage ventures or having some experience or expertise in a particular industry. Usually they'll get either a SAFE, a convertible note, or a Series C preferred. And usually those investors, not usually, quite frankly, often, well, always, those investors are accredited, right? They're high net worth again, so they meet the threshold for accreditation, meaning that it's easier to comply with securities laws in connection with issuing stock. So I know that was a brief summary there. Obi, did you talk to angels at all? And can you maybe briefly describe what your experience was if you went out to seek angel financing?
I did. I did talk to a lot of angels. I got the sense for me personally, a lot of them had a bit more, I guess I could say a bit more risk averse. So they didn't want to come in as early. So they wanted to come a little bit later. So that was the top feedback I got from angels. Backstage Capital as a VC came through with the most. And of course, from there, I went to the equity crowdfund route. I think one good point to point out in conjunction with negotiating rates and whether it be convertible note or setting a valuation is what will the money do when you get it? So let's just say if they wanted common stock and they were angel and they were bringing in, let's say $200,000. That's so significant that I might do common stock and just negotiate that out just because it's going to bring so much value. But if it's just 25K and I'm like, okay, this is a runway of like 2 months, it's not really much, then I probably wouldn't. I'd probably like, okay, no, this is a convertible note, and then work on getting other investors to get us to the full mark that we need.
Yeah, I think those are good points. Essentially, so yeah, to the extent that you can issue common stock, obviously you should, right? That's the same priority and preference as you as the founder. A lot of investing sources are actually going to require preferred stock. And so again, that's a negotiation and discussion, but certainly to the extent that you can issue common stock and the investor is willing to take it, then you should. And I think another point on valuation, just another brief conversation. So I want to underscore that at the early stages of your company, valuation is really just an open question, right? And we often get questions regarding, well, how do you determine valuation, and how do you know what's right, and how do you resolve differences where two different parties have very different expectations with respect to what the value of your business is, right? And there really are no, unfortunately, right answers here, right? The point is, valuation is a combination of factors, right, that go into making a determination of what your business is worth. And you might have information with respect to prospects, upcoming contracts, the interest of potential strategic partners and customers, right, that you account for in terms of figuring out what the business is currently worth. Investors may have the same information, but might discount it, right? And so again, there really is no right answer. It's a conversation between the investor and the company, where they've got to go back and forth, providing assumptions, providing the bases for the valuation, and then challenging those assumptions in order to try to meet in the middle, essentially. The other point I'll raise is at very early stages, valuation is often is more of an art than a science, right? So you may argue until you're blue in the face regarding why the valuation that you have proposed makes sense. However, from the early investor's perspective, they sometimes like to obtain a particular range of investment, right? So anywhere from, let's call it 15 to 30% of the business. And so if that's where their sweet spot lies, then the valuation that they're going to provide is essentially going to facilitate them ending up with ownership in that range. So sometimes it's, again, more of just an art with respect to the investor wanting to end up with a particular range of ownership, as opposed to a specific elucidation of exactly the specific factors that go into determining value. So just a point, I don't know if you had any experience, Obi, with respect to trying to convince someone of a valuation only for them to kind of be stubborn and essentially want to get to what is particularly a range.
Exactly. I think our biggest point that we leaned on the most is the advancement in technology. So for us, my argument was, look, it's not some dating app that anybody can reproduce. This is significant, like AI technology that's extremely complicated. Even if you felt confident in competing with us and building it, it's going to take a highly skilled team that you're just not going to get out of AngelList or any other platform in hiring. You really would have to go to MIT or some of the top schools and mine those students and faculty to get that level of expertise. So that was one main thing we leaned on the most. Of course, potential patents that we could go after as well. That was another major thing that we leaned on significantly, and as well as my background. So this is Unami's my second startup. Nido was my first startup, which was acquired by AOL, and that was facial recognition technology, and we had patents for that as well. So that culmination, trifecta, is what I really used to like build up the valuation or defend the valuation of our company, as well as the expertise of the engineers involved.
Okay, great. All right, so let's keep going because I want to make sure we cover, VCs and corporate VCs, and then we can get to crowdfunding, which I'm sure is of interest to lots of folks. So once you've gone through the angel round, typically the company will next move to raising capital from venture capitalists or corporate VCs. So venture capitalists are essentially sophisticated investors that are professionally managed. They aggregate funds from high net worth individuals and institutions, and they often invest again in growth stage companies. Typically, a VC requires, a real product, or some kind of commercial product. Again, there are some early stage VCs, but we've seen a movement in the marketplace where most require a product, some interaction with users, potentially some interaction with customers in order to actually pique their interest. Due to the complexity of the investments that they make in the business proposals, VCs often limit themselves to specific industry sectors where they have both the expertise to evaluate deals and the experience to add value to the investment. The usual security for venture capital investment is a Series A preferred stock, and it's got all of the rights and privileges of the Series Seed with more. So in addition to the liquidation preference, in addition to dividends, there will also be anti-dilution protection, which essentially means that to the extent that the company issues shares at a price below the shares at which it sold the Series A, then the investor has an adjustment to facilitate the conversion of their Series A to more shares. That's typically how anti-dilution works. They'll also have more protective provisions, more veto rights in connection with actions that the company cannot take without the approval of the investor. They'll usually require a board seat, right? So the ability to designate a member of your board of directors. They'll usually require, or in some cases require, redemption rights, which essentially mean that anywhere from 6 to 7 years after their investment, they get to force the company to repurchase their equity. Now, redemption rights aren't, always included, but some investors ask for it at very early stages. So you should be prepared to, encounter and negotiate redemption rights to the extent that you're seeking a investment round from a VC. In addition, they have what are known as drag-along rights or compelled sale rights. And essentially what those are is if a group of investors and common holders decide that they want to either enter into a liquidation transaction or a liquidity event such as a merger, or if they want to sell a significant portion of their stock to a third party or group, then they get to approve that transaction. And if they approve it, everyone who's signed on to the applicable agreement also must approve the transaction or must sell the same percentage of securities. So that's generally what's known as drag-along rights. A select group that approves it gets to drag everyone else along who signed the agreement. And that's a fairly typical right that's provided to VCs. In addition, they get registration rights, which are the ability to ask the company to file a registration statement with the SEC to register the resale of the stock that the VC essentially owns, right? Now, generally they own preferred stock, which they would convert into common stock in order to sell into the public market. But it's a right that the VC has to force the company to file a registration statement once certain conditions are met, usually time-based, usually after the IPO. There are other criteria as well. And this is just a way for them to obtain liquidity in connection with the investment that they've made. Briefly, they get information rights as well and inspection rights. So again, financial statements on a regular basis and the opportunity to inspect your books and records. And then usually they also get transfer restriction rights. So a right of first refusal, which essentially is a right that says to the extent that the founders want to sell their equity, they first have to offer the same deal to the company the company doesn't take that deal, then they've got to offer that deal to the investors. So it's ability to control kind of who the owners of the business are. And then in a circumstance where neither the company nor the investors decide to take advantage of the proposed transfer, then there's also a co-sale right, which enables the investors to participate in the sale negotiated by the founders. And I know these are kind of complicated, but this is just an overview of the terms and conditions that you can expect to see with respect to a investment transaction from a VC. And all of these rights are usually laid out in a term sheet, and they're laid out in much more specific detail in the applicable documents that you'll enter into in connection with the financing transaction. But this, again, is just giving you a general sense of kind of what to expect. Corporate VCs are just more strategic partners, large businesses that are interested in investing in early stage companies, either in their business segment or doing something that's ancillary or similar. So you might see, for example, Intel, well-known Intel Capital, right? Intel invests in lots of businesses in the early stage, depending on whether or not Intel views those businesses as having a strategic fit with Intel. Okay, so corporate VCs are just more strategic, more focused on a particular segment. And Obi, we've talked about VCs. So I don't have to, given where we are in timing, I think let's move on to crowdfunding really quickly.
Yeah.
You've got experience handling your own crowdfunding offering, and so I'd love to have you give some thoughts with respect to that process and why you found that more effective as opposed to going to some of these capital sources that we've referenced. So really briefly on crowdfunding, the Jobs Act allows companies to raise up to $1,070,000 from unaccredited investors, which is why it's so popular, within a 12-month period. Usually you can raise from any particular investor the greater of $2,000 or 5% of their annual income or net worth if that's less than $100,000, or 10% of annual income or net worth not to exceed $100,000 if the annual income or net worth is over $100,000, or at least $100,000. Usually the round has to be consummated through a funding portal, and Obi will tell you about the funding portal that he used. And then again, the company has to comply with various reporting and other requirements, including providing financial statements, depending on the amount of money raised. So Obi, would love to have you kind of walk us through the crowdfunding campaign that I think is consummating right now.
Yeah. So this is actually our second equity crowdfund on microventures. So for me, the equity crowdfund ultimately replaced the angel round. So this allowed me to kind of really reach out after or go after a market where that really understood what we were building and allowed them to invest. So I chose microventures at the time just because they had the least amount of fees. So a lot of these, every one of their various portals that you could use had various different fees. I mean, I've seen some where it's, I think after you raise the capital, they take 10K plus 7%, the additional 5%. Some will take, I think, 3% in convertible note on top of all of that. So you definitely have to read the fine print and the paperwork and really understand the percentage that they're going to take out. It also varies if you're doing a Reg CF versus, I think, a Reg D. There's just multiple versions that they have out there, and it dictates the amount of capital you can raise and the amount of time that you can raise it as well. So what we did is what's called a roll and close. So the first time we just did, I think it was a Reg CF, and we raised up to 107,000 on microventures. And then this time we're raising, I think, well up to around 250,000 with a roll and close, which means once we raise $75,000, we could take it out, start using it, build the company, and keep raising on that platform, which I think is amazing. By the way, it really helps startups like ours versus you having to wait the full 1 month, 2 month, 3 month, or however long the campaign is. You're able to kind of raise that capital, start using it immediately, and help scale it and grow your company. And I think, so the process is, it's going to probably take about a month to get on their portals. They're going to need all your financials from inception. So that's one major heads up. They're going to need all that information. You're going to have to create all the marketing materials. So, it's definitely be prepared for that. And then you're pushing the campaign just as hard as they are. And so if you've ever done like a Kickstarter campaign, it's very similar to the flow of a Kickstarter campaign.
Great. And the lawyer in me has to say as a disclaimer, this is not a solicitation for investment. Obi is obviously simply describing the process pursuant to which he has raised capital via crowdfunding. and any interest in investing obviously would be directed to Microventures itself.
Exactly.
Okay, so maybe we can pause there. We're exactly at almost quarter till to see if there are any questions from the audience. And I know we discussed a lot, so again, don't be shy, and if we can expand on any specific topic we've discussed or any other questions, feel free to let us know. All right. Well, while you're all thinking, what I will say is essentially, look, again, information with respect to various funding sources are available, online, right? So to the extent that you're looking for grants and/or prizes, you should be able to do research to, understand and see what's available. Reaching out to organizations such as Plug-in South LA, taking advantage of the folks in their network, and that organization can also assist with respect to providing information that they're aware of in connection with where you can find these sources. Angel groups are all out there. VCs all have websites. Attending community events and just networking in the community are great ways to meet funding sources and to obtain information with respect to capital that's available. So, there's no shortage of information for you to take advantage of, and so we highly recommend that you do so. Okay, so I see a question from Andrea. Is there a niche place to find specific investors or VCs? So unfortunately, well, I guess I'll say this. AngelList is one source where you can find, again, a group of angel investors. And typically companies post on AngelList to obtain information and insight with respect to investors. But no, there's no kind of central repository with respect to, here are all of the VCs. Again, it's more of a research project, you understanding kind of who's in your industry. Once you figure out, one investor, you can, again, do additional research to see if they co-invest with other investors, if they're part of a syndicate of investors. So yeah, unfortunately, I can't point you to a central repository of information, but again, once you kind of figure out who's investing in the space, usually and hopefully that information can lead you to other investors that they co-invest with. Obi, I don't know if you have any thoughts on that.
Yeah, I mean, I could add to it. I mean, you could also go to Crunchbase. There's plenty on there. I think you could literally Google investors that invest in X. So I know there's another question saying any specific investors that invest in the game space. I would say you can literally Google it and it will come up. I think there's also filters in Crunchbase and AngelList that will allow you to kind of do more thorough searches as well. And LinkedIn, you could also do a search on LinkedIn as well.
Yeah. Andrea, you've got another question. How do we find a broker of sorts to assist with finding an investor and or walking us through all of this? That's a really good question. And I'm glad you raised it because there are two issues here. The first is that essentially, to the extent that a broker or finder is essentially receiving what is known as transaction-based compensation, i.e. 5% of your raise, right? And assisting in, raising funds from, capital in multiple states, then typically that finder needs to be a registered broker-dealer, right? Registered with the Financial Industry Regulatory Authority. So to the extent that you encounter a finder that wants to help with this process, you want to ensure that that finder is actually a registered broker-dealer. If you use a finder that is not a registered broker-dealer, then there could be a rescission right where investors get to claw back, request their money due to violations of applicable securities law. So it's really important that you find a registered broker-dealer. Certain states do have exemptions for intra-state, i.e. solely in one state, finders. California is one such state. I think that they came out with this regulation in, I believe, 2018. But there are a lot of requirements that the finder must comply with in order to actually be registered under California law. And the process requires first an initial set of filings with the California Regulatory Authority, then reports and information with respect to what they're doing in connection with the transaction, with very limited opportunity for them to assist in negotiating and structuring the transaction. So again, if you're looking for an intrastate finder solely in California, you want to ensure that that person is, again, registered and complying with the reporting and other requirements that they need to in order to be a valid bona fide finder. And again, the result is if this person is violating applicable law, then there could be a rescission right available to your investors. So great question, really important. And then in terms of where you find them, again, unfortunately, I don't have a repository of information with respect to where you find finders, primarily because most finders aren't registered broker-dealers, right? They don't comply with the applicable requirements under federal and state securities laws in order to actually undertake the steps of assisting the company in the transaction. So unfortunately, often when clients come to us and say, yeah, I've encountered this finder, I ask these questions, and unfortunately the answer is usually no, they're not registered, in which case I then inform the company that they're not permitted to use that finder in order to have a compliant offer.
And they, I'm assuming, registered under FINRA, correct?
Correct.
Yeah. And I think the next one they're asking for how to fund the marketing and branding for the crowd campaign. Personally, our team built out all the marketing materials, so we didn't have to fund that. We naturally I do that personally. So I was doing the editing and the animation and the filming for all that. So that's generally something you're gonna have to probably most likely bootstrap and do internally with your team. Unless you have the capital for it.
Okay. And then really going back briefly, I see that Toby's asking, what do I mean by a finder? So typically a finder is a consultant that indicates that they have the ability to locate investors for you, right? So for some reason, either through a network or some other interaction that they've had, they want to assist your company in the process of raising capital. So let's say you need $500,000 to build your MVP, right? The finder will say, yes, I have a network and I'm able to, locate the investors that might be interested in investing in your company. And in consideration for my services, I will receive X amount of the raise, right? Or some amount tied to the amount of money you raise. So that's what I generally mean by finder. Okay. And then, Andrea, your question, where did the laws that Obama inducted, i.e. the Jobs Act, come into play, and how can that info help startup businesses? So again, the Jobs Act is the essentially regulation that initiated equity crowdfunding, right, for startups. And so the crowdfunding campaign that OB just undertook is as a consequence of the rules and regulations for crowdfunding implemented under the Jobs Act. So again, companies can now seek capital from unaccredited investors, provided that they meet the requirements of the regulation CF, which is regulation crowdfunding. They've got to go through this equity portal. So there's an intermediary. All inquiries with respect to the investment need to be made to the portal. It can be generally advertised. And then again, you can raise up to $1,070,000 at this point, depending on what you need to raise and depending on the information that you provide in connection with the offering. Really briefly, the Jobs Act also provided the ability to advertise generally for offering solely to accredited investors, right? So not involving unaccredited investors, but accredited investors. And this is what OB was mentioning earlier with respect to a Reg D, I think it's 506C offering, right? And so you can generally advertise in certain circumstances, again, depending on complying with the requirements of 506C. And then there was also Regulation A+, which was a refreshment of Regulation A, which permits companies to go out into the public market and raise up to $50 million. That's kind of a mini registration statement. It's a very onerous and robust process. So to the extent that companies want to take advantage of that, they are, of course, welcome to do so, particularly if they need to raise lots of capital. But again, the reminder is that that process is essentially a registration statement or a mini registration statement. The company has to provide significant disclosure with respect to its business, its management, its prospects, and its financials. But those are some of the new, avenues that came into play under the Jobs Act that will assist in fundraising for early stage ventures.
So I think there's another one. How hard do you find it to find investors in the game space? Basically, so for me, I'm a bit more in software. So I'm software for the video game and animation space. As for finding investors in the game space, my best guess is it's going to be a bit difficult. You will need a proof of concept if you're reaching for investment in that space. I would assume that you need to have a significant portion of the game done, if not already done, and then present to investors. I highly doubt, or not doubt. I think it's going to be a deep struggle to pitch a concept for a game to investors for them to actually back it. Just because there's a lot of indie people out there that will build it from scratch with their own team, and investors will much rather go that route and invest in something that's already fully fleshed out versus just an idea.
Okay, last opportunity for questions. If not, we'll give you back your 3 minutes. There we go. So I think a question from Andrea, can the SBA, the Small Business Administration, be a starting point for a startup in finding an investor? I haven't had that opportunity. The SBA usually facilitates the provision of loans. Again, from banks, right? The SBA essentially guarantees loans made by various banks that participate in its programs. You may have heard of the PPP, the Paycheck Protection Program, which was recently implemented last year during the pandemic. The SBA was the administrator of the PPP essentially, and worked with banks to guarantee the loans that were made to businesses to be used for primarily payroll and other certain other expenses. So generally speaking, the SBA usually, in my experience, provides the ability to obtain debt financing. Rarely do they provide information with respect to equity investment sources. Okay. Well, everyone, thank you so much. Obi, thank you for your insights. I'm sure that your perspective was way more interesting than the dry facts and figures from the legal perspective. I also wanted to thank Plug in LA and the Forward Conference for giving us this opportunity to provide this information. To the extent that anyone has questions, feel free to reach out to either Obi or me, and we'd be happy to follow up with you. Thank you, everyone, for attending, and I hope you have a great rest of your day and a great conference. Thanks so much.
Thank you.